Welcome to the Well Off Podcast, where the goal is to motivate, inspire, and share success principles. I'm your host, George Masri. Thanks for joining me. I interviewed August Biniaz, who is a real estate developer, fund manager, general partner, and the co-founder of CPI Capital, which is a real estate private equity firm helping investors acquire multifamily assets. He's been involved in the closing of over $208 million worth of multifamily assets. And on this episode, we talked about a real estate private equity firm versus a REIT, where CPI Capital is currently investing and why, the advantages of a syndication model, the compliance around a private equity firm in Canada versus the US, the benefits of working with an exempt market dealer. We also broke that down a little bit to explain what that is, the structure of his limited partnerships. So I think if you guys are interested in investing in this type of project, or if you plan on starting your own private equity firm one day, you're truly going to benefit from this information. And we're actually starting to look into acquiring some larger units, larger buildings in the Niagara region. So if you'd like to take part in that, then I encourage you to reach out to me on Instagram, WellOffX, or by booking a call on the website. Just go to welloff.ca. And don't forget to leave us a 5-star review on the Apple Podcasts platform, and like and subscribe to us on YouTube so that we can continue to share a positive message and help investors grow and build up their portfolios. So there you go. Enjoy the episode. I'm here with August. August, thank you for joining me. I guess you're in Vancouver, right?
Yeah, absolutely. My pleasure. Thanks for having me. Yeah, I'm here in Vancouver.
Awesome. Okay, so the way I start off is by asking you a bit about your childhood. Do you want to just tell me about where you grew up and a couple memories?
Ooh, childhood. All right. Well, I had a kind of a whirlwind of childhood. I was actually born in India. I lived there till I was 4 years old. I do have some memories of India as a child, and then we moved to Iran, where my family is from. Lived there till I was 14, and then moved to Canada.
What was the inspiration for August?
It's the month I'm born in. It's I love the name.
Okay, there you go. The month you were born in. That's all you had to say. Okay, so what was tell us a little bit about your transition to Vancouver, starting your company, CPI. I guess you're one of the founders, I'm assuming?
That's right. I'm one of the co-founders of CPI.
Okay. So yeah, why don't you tell us a bit about your journey to Vancouver and starting CPI Capital?
Well, my journey to Vancouver was early on as a young teenager, but I in my early adult life, I got involved in construction as mainly a site construction worker. Saw the tremendous opportunities that existed in that business, and I wanted to be involved. Eventually became a real estate agent. But again, I was more focused on the contracting side of the real estate, where I was doing small fix and flips as a real estate agent rather than being more focused on brokering deals. I eventually started my own general contracting company, grew that general contracting company to be focused on building custom and spec single family homes, more on the luxury side, and eventually got involved in doing larger ground up development projects, townhome projects, where I was syndicating these deals. That was before I even knew what the syndication model was. But what that essentially means is I was finding the deal, finding the investors, hiring all the professionals, and being compensated relative to the performance of the asset. And always wanted to start an investment firm that was focused on ground up development projects here locally in Vancouver. But a lot of educational content I was receiving was coming from the US. And as I was educating myself in this space, I realized that the asset class, the commercial real estate, and the asset classes within it that the other groups were focusing in the US, the yields that those projects provided were much higher than the projects I was looking at to do here in Vancouver. And most of these deals were cash flowing from day one. And that kind of started my journey onto exploring opportunities across the border, eventually co-founded CPI Capital, but I'll let you ask more questions.
Okay. So CPI Capital, do you just want to give us a quick breakdown of what you guys do? I know you were talking about your sort of background, but tell us a bit of what CPI is doing today.
Absolutely. CPI Capital is a real estate private equity firm with its mandate to acquire multifamily and BTR, SFR communities in the Sunbelt states of the US. What is very unique about CPI Capital is that our LPs are both Canadian retail investors and US investors, which they invest into our project-specific funds. Also, what sets us apart is that we are our leadership team and our company is very focused on the educational side of things, because real estate private equity could get complicated at times with a lot of different words that are used in this space and a lot of different ways that deals are structured. We have our own YouTube show, podcast. We create a lot of content online, again, in the pursuit of educating investors, but also as lead magnets to bring investors to realize our company exists and then eventually possibly invest with us.
Mm-hmm. Okay, just in case anyone was listening, because you did throw out some abbreviations there. So LP means limited partners. So the way you guys are structured, you have a general partner and then limited partners, and you're acting as the general partner, I'm assuming.
Exactly. So a limited partnership is an entity which is comprised of limited partners who are passive investors who have limited liability, and their contribution to the deal is mostly capital, the equity. And then you have the general partner that has unlimited liability, and they manage the project for a portion of the profits that are agreed upon between the limited partners and the general partners. The entity at once is a limited partnership and is usually an entity used by a lot of private equity firms, large hedge funds. You can hear a lot of times Blackstone started their a certain fund or certain real estate fund, which is structured in a limited partnership. So it's a great entity to use when you're having investors who are totally passive and a general partner who manages the project.
Yeah. And you mentioned kind of that you were investing in the States. Which states are you investing in particularly, if you can share that?
For sure. Currently, we're invested in Florida. We're in Orlando, Florida. We're in Charleston, South Carolina. We're in Houston, Texas. And our most recent project we're working on is in Tucson, Arizona. We are geographically diversified, and we feel very proud of that. And the reason we're focused on these states is because really the business friendliness of the states, the tax friendliness of these states. Also, there is a interstate migration taking place in the U.S. A lot of people are moving out of California, moving out of New York, and moving to these lower cost of living states, these lower tax states that there is tremendous job growth because a lot of Fortune 500 companies are also moving to these states. So we were following the numbers, really.
Mm-hmm. Okay. And again, in case someone's listening and they're not really sure how this works. So if they're passive investors, they have some capital, they come to you and say, hey, I have X dollars. I'm interested in the project. Are you assigning them to one particular project, or are they getting kind of a piece of multiple projects?
Yeah, no, great question. So in our case, the way we structure our deals are through the syndication model. So project specific syndication. So a deal comes across. So obviously we're underwriting many deals in many different regions, but after a deal passes our underwriting process and our due diligence process, and we're looking to move ahead with that deal, that's when we create the corporate entities needed, and we present the deal to our investor community, at which time the investors make a soft commitment and eventually invest into the deal. But that's that particular deal, that specific deal. So they're very intimately understand what the deal is and what the returns are and what the business plan is going to be. Now, that is the syndication model, the project-specific fund model. But there is also the fund model where a lot of investment groups utilize, which is an entity, again, a limited partnership, where they have a certain mandate. Their mandate is to raise a $100 million fund and purchase multifamily assets within the Sunbelt states. So they're continuously raising capital for that fund to hit that $100 million mark, and they're continually deploying that capital and allocating and purchasing different assets. So the entity itself houses and holds many different properties within it, or a few properties, depending on the size of the fund. But syndicated investments historically have had higher returns than funds or these larger entities, because usually with funds it's an aggregated return of non-performing or low-performing assets and on the high-performing assets. Also, the cost of managing a fund is substantially higher than compliance costs, accounting costs, legal costs is much higher than these syndicated investments as well. So as far as yield to investors, syndicated investments historically yield larger, but also risks associated with syndicated investments are higher than funds in some cases. And you can say the same thing about REITs. REITs are basically publicly traded funds. So it's basically the levels of risks that investors want to take and the type of returns they're looking for.
Mm-hmm. Now, to go back on something you touched on, you said that typically you would present a particular opportunity to investors and then have them do a soft commitment. Is that once you have a property under contract, or is that even before that happens?
Yeah, great. Again, excellent question. And I can go over kind of the process, the journey that the investor takes when they eventually receive one of our deals. But in a competitive market, which commercial real estate has been over the last 20 years, has beat the S&P 500 by leaps and bounds. It's a very competitive market. The market is definitely slowing down now because of the increasing interest rate and the environment we're in, but it's still a competitive market. So if you haven't signed the PSA, if you're still in LOI phase and you're still in negotiations with the seller, it's difficult to advertise the deal to your investor community, because currently we have close to 3,000 people as part of our investor community. Some are current investors, some of them are past investors, some of them are associates, but some of them are people that we haven't been on a call and we don't know very well. So when a deal goes out, even though it's going to our community, we feel that it is being publicized. So it's very important not to send a deal out to the public. Even though it's our community, somewhat, so you never know who will share the email with who else. So it's very important to be under contract prior to sending the deal out. Now, the marketing material and the due diligence and all the planning, if the deal is looking like it's most probably going to go ahead and just finalizing the last items on the PSA with the seller. Sure, you can create your pitch deck. You can plan for all your marketing strategies. You can talk to a certain selected few investors that you've worked with over the years. Sure, you can market it in a kind of a marketing light, but not full-blown marketing to everyone prior to signing the PSA.
Okay, 2 questions on that. So you said you're working with Canadian and U.S. investors. Are there different kind of levels of compliance depending on who you're marketing to, or is it more or less universal?
Again, excellent questions. You're definitely getting your money's worth here. But yeah, no. As far as obviously, yeah, the regulatory environment in Canada and the US are similar, but they're also vastly different. There's also a lot of terminologies and words that are used across the border, which have different meanings, which gets a bit complicated when it comes to investors. For example, accredited investor, requirements, or the accredited investor exemption. You also talk about the crowdfund, different exemptions that exist to raise equity on both sides of the border. And this, to break it down a bit, really is the securities commissions exist in Canada and the US in the protection of investors, for the protection of the investors, because of bad actors and unscrupulous fund managers in the past. So they're there for the protection. And now, if this is fair or not, the way they have put this together, both in Canada and the US, they've said accredited investors, because these individuals are high income earners or high net worth individuals, because of their business acumen to have been able to get to this stage of wealth, they must be knowledgeable. So they must be able to make certain investments. They must be aware of what type of investment they're making. So as soon as you're accredited in Canada or the US, and there's slightly different accreditation requirements, which makes you accredited in Canada and the US, and I'll get into this in a moment. But pretty much carte blanche, you have access to any investment opportunity. And if you're not accredited, then there are other exemptions or other ways you could participate in exempt market or alternative investment space. So that's really how it's these two main categories are divided. And this is all on the retail side. On the institutional level, it's really different. You have family offices, pension funds, university endowments that invest in private equity or alternative investment products that have a certain percentage of the allocation in these asset classes, and they're automatically considered accredited. So we're talking on the retail side, you're divided between non-accredited and accredited investors. So I can talk about this for a minute here, but so accredited investor in Canada is someone individually who makes $200,000 a year, or with their spouse makes $300,000 a year. So that's one way to be considered accredited. The other way to be considered accredited in Canada, and it's one or the other, it doesn't have to be all of these, is that you have $1 million in financial assets. So there is a level of liquidity with financial assets. So stocks, bonds, cash in a bank account, other types of investments that have liquidity, or $5 million in total net worth. So if you own a $10 million home and you have a $5 million mortgage on that, you have $5 million of equity, you're considered accredited. There's also other ways you can be accredited if you're a director of a company, and if you are also a security license holder, you can also be accredited because you're in the industry. In the US, it's somewhat similar. So again, an accredited investor is someone who makes $200K a year, but it's 200 USD compared to Canada, which is CAD, or 300K USD with your spouse, or is someone who has $1 million in total net worth, not including their primary residence. So that's the differentiating factor, that your total net worth in Canada could use your primary residence. In the US, it couldn't. All of this stuff I'm saying is with a caveat that I'm not a lawyer or an accountant or a security specialist. So you need to check in with the securities commissions in the province you're living in Canada, because every province has their own requirements. But overall, you get a picture on the educational side, as I'm saying, that's how it is in the US. So the accredited investor is really seen as someone who has $1 million in net worth, not including their primary residence. So in some ways, it's easier to be an accredited investor in the US, and accredited investors have much more options when it comes to these types of investments, and that kind of makes it harder for non-accredited. I know I've been on calls with investors, and they're like, "Hey, I make $150K a year. I have many investments, and I'm still not considered accredited." The deck is really tilted against me, and that's true. People with higher wealth and higher incomes have better opportunities for investments.
Mm-hmm. So as somebody who's running a private equity firm, are you only allowed to pitch to accredited investors, or can you pitch to others as well?
So there's two components there. One, this is the idea of pitching. In the US, is very black and white, and I'll get into the way it works as far as pitching. In Canada, not so much. What I've learned about the Securities Commission and the regulations across Canada is very vague. It's very gray. So it's very important to be extra compliant and extra vigilant, because most securities commissions, most people who work there are lawyers. I'm like, why do these guys have so many lawyers working there? Because they're there to again, look for those bad actors and stop them in their tracks. But it's important to be overly compliant here in Canada. So it really depends. It depends on what exemption you're using to raise your equity. And that really depends on how much capital you're raising, what's the frequency you're raising capital, what is the total, what is the total number of investors you're looking to bring on, what's the timeline of your investment. So it really depends on many different factors to be able to answer as far as pitching, to be able to pitch to investors. But if you're utilizing, for example, the accredited investor exemption, which your investment is only available to accredited investors, those accredited investors, as far as advertisement, as far as pitching, it allows you to pitch and promote your deal to investors, but where it could possibly trigger issues, and this is a kind of people have a misunderstanding that, oh my God, somebody put a deal on Facebook. This is really bad. They broke some securities law. It depends. If they have a deal and their deal is for accredited investors and they want to advertise that deal on Facebook, they have every freedom to do so, except if they're doing that on a regular basis. If they're constantly having deals, constantly promoting those deals, now they're triggering other requirements by securities commissions that could cause some other issues. But if someone has one deal and they want to bring on accredited investors and that's the exemption they're utilizing, then they have every freedom to advertise the deal as long as they're not making false claims, or as long as they have a proper subscription agreement in place, proper entities, in most cases, as long as they perform as well. Security commissions usually, in most cases, get involved when there is an act of fraud or an investor is making a complaint.
Mm-hmm. I guess I'm not really sure, but sometimes on Facebook, I'll see deals like that. And I just wonder if they're just putting in the asterisks of like looking for accredited investors only to protect themselves from something. But I don't know if that necessarily would, if like you said, they're not meeting some of this other criteria.
It's, I mean, as far as kind of, is it a facade for them to connect with investors? They're putting accredited investors. It really depends on what exemption they're using, because if they are using the accredited investor exemption, but they're allowing non-accredited investors to participate, that could have big trouble for them in the future. Mm-hmm. Even if nothing goes wrong, even if there's no complaints, if in case of an audit, or in case of the Securities Commission looking into the offering they've had, that could cause big problems. So again, it goes back to those exemptions that exist. And if I may, I'll touch on what, a question comes up: exemption from what? Exempting from what? So in most cases, if you're looking to raise capital for a business venture or for a business idea, you have to go through drafting a prospectus and go through an IPO, through the public markets, raising money for a publicly traded company. That's the normal way of raising capital. But August comes with his team and is like, hey, hold on a second. I want to buy an apartment building in Tucson, and it's a very competitive market. I have 45 days to go close, and economically, it doesn't make sense for me to go through the prospectus route and go through the IPO route. I need the funding now. So how am I going to continue doing business if I can't raise money for my buying this apartment building? Security Commission says, fine, August, we'll let you still raise money, but we'll allow you exemption from going through the public market. Here are a list of exemptions you could use to raise money for your apartment deal you're buying in Tucson. One of those exemptions is the accredited investor exemption, which I explained to you what accredited investors are. Go right at it, raise as much as you want, no minimum, no maximum, follow the other guidelines, you'd be okay. The other exemption you could use is the crowdfunding exemption. Now, the crowdfunding exemption has its own, regulatory guidelines, but you're capped at $1.5 million. You can utilize the friends and family exemption. You could utilize other exemptions that exist in Canada that you could raise capital for. So that's kind of the idea of exemption and what exemptions exist. So you need to stick to the exemptions that you like, or the offering memorandum exemption. Offering memorandum exemption really allows you to raise from accredited, non-accredited investors for any amount. But it is a comprehensive document that you need to put together. There is need for audited financials and a lot of other information. So in a 45-day close, that might not be enough time to draft an OM and have that circulated between your investors. So you don't really see an OM in a syndicated investments. You do see them in a fund that they're continuously raising capital. So those are the exemption. Now on the US side, there are also exemptions from going the public market route, but the exemptions are much more straightforward. And a lot of times when you hear people about advertisement that you could get in trouble, they hear something in the US and they connect it with Canada. In the US, if you want to raise capital, there are really two exemptions that you could utilize. Is the 506C, C for Charlie, or 506B, B for Bravo. So 506C, you can only raise capital from accredited investors, and your accredited investors have to be verified by a third-party company. And you can advertise, you can promote, you can put it on Facebook as much as you want. That's one of the ways you raise money from accredited investors. 506B allows you to raise capital from accredited and non-accredited investors as long as you've had a pre-existing relationship with your non-accredited and accredited investors. So logically, if you've had a pre-existing relationship, you don't have a need to advertise in public about your deal. So hence why you're only restricted to your internal database or your internal community. The moment that you advertise your deal, which is a 506B offering that is for accredited and non-accredited investors, now you've triggered having to be a 506C and only allowing accredited investors to participate. So in the US, again, is a bit more black and white and is a bit more direct, where in Canada is a bit more vague, and you have all these exemptions, you have all these different provinces that have different regulations.
Okay. Yeah. So I guess if you are going down that path of having a private equity firm, you have to really know this stuff, consult with a lawyer, and so to avoid getting yourself in trouble.
I'll take it a step farther. Just last point on this.
Yeah.
The compliance is so opaque and is so convoluted here in Canada that CPI Capital has made the decision that our securities are not these limited partnership that I told you, that people that invest in limited partnership receive limited partnership units. Those units are considered securities. So at times we sell securities or we might be in the business. So the decision that CPI Capital has made is that our securities are only sold through our exempt market dealer. An exempt market dealer is an entity who's licensed through multiple provinces, and they're actually the ones selling our securities rather than us. So in a way, we're washing our hands when it comes to any compliance issues. Somebody wants to invest with us, we might have an initial conversation, getting to know each other. But if they want to invest with our firm, that's when we forward them to our exempt market dealer, who does the actual KYC, KYP, and sells the securities to the investors. So that's how difficult it could get for a larger private equity firm that's looking to raise capital on a continued basis.
Right. So this exempt market dealer kind of acts as a sales agent, and they're the ones that are going to vet the investor. They're going to make sure that they meet the qualifications and whatnot, and then they'll put them through to you at that point.
Two main services that an exempt market dealer offers. One is they raise capital. They're in the capital markets. You can retain their services to raise capital for you. And number two is compliance. They can look over your marketing material. They can look over everything you're doing. And so there's a compliance component to it as well. For us, mainly, we utilize our EMD for compliance side of things, not to raise capital for us, because the cost of capital might be higher than what we have factored into our deals.
Okay. Sounds good. Okay. I wanted to dive in a little bit, if we can. I know there's probably some limitations as to what you can share, but are you able to tell us for your investors, for your limited partners, are you offering fixed returns on a project, or do you offer an equity stake, or a combination of both?
Yeah, so we offer, so our investments are in most cases cash flowing, or they will soon be cash flowing. So there is really a partnership here, and the partnership really says that, hey, we're going to get into business together. We're going to buy this asset. We're going to conduct our business plan, execute the business plan, and we're going to share the profits. In our case, is a 70-30 split in the benefit of the investors. So any profit that the project makes, we're going to go 70-30. You make 70%. We, as the entity managing and sourcing the deal and doing everything, gets 30%. Now, as far as projections, or as far as forecasted returns, of course, in our underwriting process, in our underwriting model, we see what their forecast returns are, what is going to be their cash flow, and what is going to be their back-end capital gains, and in combination, what is going to be their total return. So, but now, as far as any type of fixed returns, we also we provide something called preferred returns. And I suggest investors who are seeking to invest in alternative investments or these types of syndicated investments always look for preferred returns and ensure the project has preferred returns. Preferred returns are frankly a insurance policy. And what preferred return says, all right, fine, I'm an investor, I'm going to invest with you, August, and you say, you've promised there's going to be a 70-30 split. But what preferred returns do is that the investor has to make that preferred return, for example, let's say 8% preferred return, they have to make their 8% preferred return, which is cumulative every year, before we split the profits anything above that preferred return. So are returns fixed in our investments? Not really. They're really dependent on where the market goes, how well we execute the business plan, where the rents are going to be by the time we stabilize the asset and we execute the business plan. So there is a variability associated with the type of returns, but as long as there are preferred returns involved, that is a fixed amount that gives an assurance for the investor that, hey, at the bare minimum, I know as long as the deal performs, I'm going to be getting these accumulating preferred returns before these guys even get a chance. And that's really putting the general partner's feet to the fire to perform, because if we don't perform and a deal doesn't do well, we don't make any profits.
Mm-hmm. Now, what if you have some sort of surprise come up, like a foundation issue or something that's going to require more capital than expected? Do you guys typically put like a clause in the agreement that the limited partners have to come up with a capital call in that scenario, or is that case by case?
Yeah, no, great question. Again, within that 200-page subscription agreement, or is also known in the US as a private placement memorandum, there are stipulations for capital calls that the general partnership makes to the partnership to keep the deal afloat. It's not a call that is resented by general partners. It's a call that some investors ask, have you ever done a capital call in the past? Thankfully, CPI so far has never done a capital call. So it somewhat stays on your record if you had a situation where there's a need for capital call, but real estate is cyclical. There are black swan events that take place. So yes, at times there are needs for capital calls, but also there are ways to mitigate the need for capital calls, which is contingency, having contingency in place, doing thorough inspections, and there are ways to allocate or spend some of the reserves on a unknown renovation or some form of defect, where yes, it might deplete the investor's returns or their cash flow, but it will not need to be to a point that there is a capital call. So there are mitigating factors that you could achieve in that. So capital call is really at one of the, it's a step before a deal failing, right? The deal failing is the most catastrophic thing that could happen. A capital call is really a step before that. So there are lots of steps prior to that, which you could mitigate risk, which is reduction in cash flow, reduction in investor returns, usage of the reserves before getting to a point of having to do a capital call.
We covered quite a few things, and I'm sure I found it really helpful to pick your brain on this. Do you feel like there's anything important that we may have missed, or do you think we covered the basics?
I think we focused a lot on compliance and regulatory items, on the way that these investments are really structured. I will briefly touch on a very interesting asset class that we have ventured into. Is an asset class that we've been looking at closely for the last year or so. I wrote an article about this asset class in December of last year. A commercial real estate, which is a very great performing industry over the past 20 years, again, beating the S&P 500, has multiple asset classes within it. One of those asset classes is multifamily. You got office space, you got industrial, you have retail, you have hospitality, and there is a new and up and coming asset class within the space that it's so new that it doesn't even have a name or title associated with it. Different people call it different things, but it's BTR SFR, build to rent single family rental. It's basically a portfolio or community of single family homes which are managed, assessed, and operated like multifamily, but cater to a larger demographic. So imagine as a tenant, you having an option to rent a 1970s or 1980s apartment, or you also have an option of renting either a brand new home or newly built single family home that you have the independence, and you're in a community of renters with others around you. Obviously, when you make that comparison, it's a no-brainer that people would choose to live in single family homes. So it's an asset class that's the darling of Wall Street. You have a lot of institutions investing into this asset class, built to rent or built for rent, single family rental portfolios and communities. We are very excited to venture into this asset class. Our most recent project in Tucson is a built to rent single family rental where we're purchasing the completed homes at certificate of occupancy after doing the full inspection from our team. We're purchasing the homes from the developer at a discounted rate to the market. So just want to touch on that asset class, the BTR SFR asset class, and so your viewers and listeners know about this asset class.
Yeah, that's something we've definitely heard a lot of lately. Like there's in the news, there's been different reports about these large organizations buying a bunch of single family homes, like 200 units or whatever. So it's definitely something that's been coming up more and more, and an interesting opportunity. I'm sure, like, if people want to find out more about the opportunities that you have to offer, what would be the best place to go to? Is there a website or like another form of contact?
Absolutely. Yeah. There's a website, cpicapital.ca. cpicapital.ca. Get on the website. We're offering a free ebook that you can download, and you can be added to our investor community. You can also connect with me on LinkedIn. I'm very active. I write a newsletter on LinkedIn with over 7,500 subscribers. August Biniaz. August like the month, Biniaz, Biniaz. Connect with me if you have a question. Reach out to me, and yeah, I'd love to add value.
Awesome, August. Thank you so much for doing this. Really appreciate your time and for sharing all this information.
Absolutely. My pleasure.
Thanks for listening to this episode. Your support is truly appreciated. And if you can share this with a friend or family member that might benefit from the information, remember, our goal is to motivate and inspire others to take action and to build wealth and to become well off. Enjoy the rest of your day.